Are your dividends even qualified, bro? Good morning, internet. How's it going? So good to see you. I got so many comments and questions regarding qualified dividends. How do you get them? When do you not get them? All these different questions. So I wanted to put this video together so I can explain how qualified dividends work, so you can walk away from this video with confidence, knowing how to achieve that for yourself. Now, if you saw last week's video of dividends versus wages, you could quickly see from a tax perspective why qualified dividends are badass, or they kick some serious ass. If you're new to investing, what dividends are in general is a share of the company's earnings with their shareholders. That's what a dividend is. It's a payout of the company's earnings. By making your living through qualified dividends, you could actually pay 68% or less in tax compared to actually going to work and working for a living versus living off investments. So it's really powerful. And I had to really study up on some of this stuff. I knew a lot of it already, but there were several aspects of these technicalities, because this is very technical stuff of how this actually all works. The biggest difference between a qualified dividend and an ordinary dividend is the tax treatment. But basically, when you receive a dividend, if it comes in the form of an ordinary dividend, you pay tax on it at your personal marginal tax rates, which I'm going to display on screen right now. As you can see, the personal marginal tax rates, they go anywhere from 0 all the way up to 37%. Now, if you receive that dividend in the form of a qualified dividend, you get a capital gain rate tax treatment instead, and not a marginal tax rate. Capital gain rates are much more favorable for tax purposes and can save you a lot of tax. So for a qualified dividend, the tax you'll pay on those qualified dividends ranges anywhere from 0 to a maximum rate of 20%. Now, what's not shown on here, that is, if your income is in excess of $200,000 per year, then you also have to pay net investment income taxes on those investment earnings, like dividends. And so your max rate would be closer to 24%. But lo and behold, no matter even if you're at the maximum income tax bracket level of 37%, the most you'll ever pay in taxes on your qualified dividends would be around 24% if your income is over $200,000. But let me just share with you real quickly on when you will not receive qualified dividend treatment. And I've mentioned some of these before in our previous videos, but one is real estate investment trust, known as REITs, master limited partnerships. Usually you're not going to receive qualified dividends from those. I have the K1 statement on screen, but generally speaking, just so you guys know, from a qualified dividends perspective, you're not going to be able to obtain that by investing in master limited partnerships. Employee stock options is another time you won't receive qualified dividend treatment. Tax exempt companies, you won't receive qualified dividends from them. Money market accounts, such as like your savings account or high yielding accounts. Special one-time dividends are not qualified or cannot receive qualified treatment. And if you're investing in options, if you're placing puts and calls, or if you're selling the market short, then you're not going to be able to get qualified treatment there either. In my last dividend investing video, somebody asked me, they said, Mike, can my ETFs or mutual funds, can those receive qualified dividend treatment? The answer is yes and no. So some of them can and some of them cannot. To get qualified dividend treatment, as long as you're not investing in the things we just mentioned above right here, these things right here, the only thing you need to do is just really hold on to the investment and not sell it. It's that simple. So here's the rules, and then we're going to look at an example on screen that's going to help break this out. It says the IRS requires investors to hold shares for a minimum period of time to benefit from lower tax rate on qualified dividends. Common stock investors must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date.
What the fudge? Can you explain that, please?
When I read that, it's really confusing. To help me understand it, I had to visually break it out. So the way this all works for a company when they're going to pay out a portion of its earnings as a dividend to its shareholders is first they declare the dividend. There's a date and time when they say, okay, ladies and gentlemen, shareholders, we're gonna be issuing you a dividend in the future. So first they declare it. Then what they do is they determine a report date. And that report date is has a list of all the shareholders by that date. As a shareholder, in order to receive that dividend payment, you have to be on their books as a shareholder at that time. And then what they do, from their report date, they declare an ex-dividend date. The ex-dividend date is basically your cutoff date. So and usually the ex-dividend date is 1 day before the report date. So ex-dividend date is usually 1 day before the report date. So basically, if you don't own those shares before that ex-dividend date, you're not going to receive that quarter's dividend or that month's dividend. Does that make sense? So to make sense of this, guys, I actually had to break this out on Excel to visually show you how this works. So what I did here, guys, is there's an example that Investopedia provides that explains the cutoff date and all that for qualified dividends and how long you need to hold them. And so let's just read that real quick here. And that's what I used. I used this information to build this. But I had to visually lay it out to make sense for me, because when I'm reading it, it wasn't making sense. It says an investor receives dividends as qualified from shares in mutual fund X. So they're using a mutual fund as the example. That investor bought 1,000 shares of fund X on May 1st. So on May 1st, that was their purchase date. So here's the purchase date is May 1st. That's when they went to start to brag to their coworkers and friends of how they're going to start receiving cash flow and they're going to have passive income. And then soon afterwards, their friends started to hate them. They said, "Shut up. We know you're doing well. We know you're investing. I don't need to hear about it." And then they went and told them about the FIRE movement and about how you're going to retire early, except when they heard the FIRE movement, they thought you're an arsonist. So don't tell people about the FIRE movement unless you explain what it is. Now, in the article, the ex-dividend date they lay out is May 15th, which is right here. That's the ex-dividend date. So what that means is that as a shareholder, this person would have needed to hold shares in the company before this date of the ex-dividend date to receive that dividend. So knowing that the ex-dividend date is the 15th of May, does this investor, are they going to qualify for the dividend? Yes. And because they purchased their shares on May 1st, which is before or prior to the ex-dividend date. So they're definitely going to be able to receive that dividend. Now the question is that dividend going to be and come to them in the form of an ordinary dividend, or are they going to get the special tax rate treatment and get the qualified dividend? Well, in order to get the qualified dividend, they would have to hold that investment for 61 days, or because it says hold for more than 60 days right here. And so they would hold that investment from May 1st all the way through July 1st. But at that point, by July 1st, now they've held it long enough to receive that dividend in the form of a qualified dividend. Now, in the Investopedia article, it didn't list a dividend payout date. There's the ex-dividend date doesn't mean that's when the dividend is going to be paid out. That's not what it means. There's another date of when they'll declare when that dividend will actually be made. Now, for the example here, I'm just going to say it's July 5th. That's when this company is going to pay out their dividend. The cash is actually going to leave the account and go to the shareholders. Now, we know this investor, we know they're going to receive the dividend, but will they receive the qualified dividend? The answer is yes, because they've met the holding period of more than 60 days as of July 1st, and the payout didn't occur until July 5th. So they're good. So that dividend should come to them in the form of a qualified dividend. To show you a real example of this, what I've done is on screen here, I hope you guys can see this okay, is this page is one of the pages from my taxable brokerage account. This is from the monthly statements I get. If you look at this statement, if you look at this page, if you go about halfway down and you see Clorox, it's a little bit more than halfway down the page. Look at Clorox, and you'll see there's a qualified dividend. So the statement itself will tell you if your dividends have become qualified when they are paid out. So in this example, I received $9.60 from Clorox. No big deal. But that dividend is qualified, which means I get the special tax rate treatment. And I also wanted to point out, see, now look below Clorox is EPR Properties. Now that's a real estate investment trust. Now remember, real estate investment trusts are not able to get qualified dividends. So you'll see there, it says ordinary dividend. So I received an ordinary dividend from EPR of $26.25. Below that is Procter & Gamble, which is a company I've owned for quite some time now. and you can see those dividends are qualified. So that's what it looks like on your actual investment statements. It's going to look something like that, and that's how you're going to be able to tell what type of dividend you're receiving. Going back to our example here to wrap things up is, now, because the payout date was July 5th, this investor had held this investment long enough to get the qualified dividend. But if the payout date was prior to this date, so let's say the payout date was June 15th, let's say the payout date occurred here, well, that investor would then, that same dividend would no longer be a qualified dividend, but it would be an ordinary dividend because they didn't meet the 60 plus day holding period, which would not have occurred until July 1st. So that's the basics of how long you need to hold an investment to receive qualified dividends. Now, I apologize, in last week's video on dividends versus wages, somebody asked me, Mike, how long do I need to hold the investment for it to be qualified? I said 6 to 12 months. Well, I'm a big dum-dum. It's nowhere near 6 to 12 months. It's only greater than 60 days, according to this Investopedia article. Sorry about that. I apologize. I totally had that wrong. But all you need to do, guys, is just hold on to these investments long-term, especially if you're a cash flow investor. And eventually, you're going to see they're going to shift from an ordinary dividend to a qualified dividend. All right, everybody, I hope that made sense. That's about how long you need to hold these things and how it works from a technical perspective of what's visually happening is you have your purchase date, you have the date the company declares they're gonna pay a dividend. They then determine a report date. From the report date, they determine the ex-dividend date of when you need to own the shares before the ex-dividend date in order to qualify for that dividend. And then they determine the date they're actually going to pay out the cash for that dividend later on. So there's all these little dates to keep track of when you purchase, to when they pay it out, to when the ex-dividend date is. So it gets quite confusing. But if you just hold the investment long enough, you don't even have to worry about this stuff, guys. And eventually you're going to get that good tax rate, and you're going to be able to make passive income and pay less taxes, which is freaking sweet. All right, guys, if you enjoyed the video today, please let me know by crushing that like button. It really helps out the channel. Leave your questions, your comments down below. I love reading everything you guys have to say. If you're brand new to the channel, I just want to say welcome. On Money and Life TV, we're all about helping you become fiscally fit. We teach finances, investing, taxes, and more on a regular basis on this channel. With that being said, it is truly an honor to have you, and thank you for spending time with me on YouTube. Interacting with you in the comment section is by far the best part about doing YouTube. So that's where I'll see you guys. Have a great week, everybody. I love you all. Now take this information and use it to live your life uncaged. I'll see you in the next video. Peace.